I'm Michael Fox, and this is the Prospector News Podcast. And joining me is often guest Chris Temple of the National Investor. Welcome, Chris.
Good afternoon, Mike.
It's been a couple of weeks since we last talked. We've had a number of things happen. There's been employment numbers, jobless numbers, CPI, PPI, rate announcement by the Bank of Canada. What's it all telling us?
Well, I'll tell you, I try and keep things as simple and understandable as possible. Not that that's always the best course of action or the correct one, but I try and keep a good high batting average and calling things properly by being simple. And I think you can break everything down. And when we saw a lot of reversals this week in markets, as we ended the week, we saw yields tick back up considerably across the treasury curve. The dollar, which has been flirting with a 52-week low and breaking a head and shoulders pattern, they circled the wagons for the dollar bulls, and the dollar ended up on a bit of an uptick. Precious metals gave back a fair bit at the end of the week. The stock market gave back a little bit of its rally, etc. And in all of these things, you can boil it down to something very simple, as you and I were talking about before we recorded, and that is the markets still do not believe the Federal Reserve and what they have told us for many months their mission is. We've got this muscle memory in markets, and you can see it whether you want to talk about gold, whether you want to talk about the big rally and a lot of the big name tech stocks. The stock market's rally broadening out a bit this week, actually. Whether you look at it in terms of the treasury prices rallying strongly, and at one point pushing a 10-year note down to almost a full percent below its peak of several months ago. Whichever of those things you want to look at, the markets have got it in their head that we've had a few lukewarm employment numbers. Inflation, as we saw this last week, is fluttering back down a bit more. We were at 9% plus year over year. With the CPI, we're down to more like 5-ish or so percent. So everybody's saying, huzzah, the Fed's going to be all done. And the Fed funds futures market is telling us that by next January, interest rates on the Fed funds are going to be about 1% below where they are right now, or nearly that. And they're wrong. There's no way to put it, but that they're wrong. The Fed is still attempting to roll off its balance sheet. There's very little question that they will raise rates again at least one more time in May. Whether they do more than that or not remains to be seen. But even if they don't do any more than that, all of the Fed heads unanimously, even if you've got a little queasiness with a couple as far as adding more rate hikes, none of them are saying that they're going to lower interest rates anytime soon. None of them are saying that the Fed's going to stop its quantitative tightening and trying to reduce its balance sheet for as long as it can get away with it. And all of that really, we're recording this late in the day on Friday. The Fed Governor Waller encapsulated all of this in a speech this morning. And it's one of the biggest reasons why a lot of these bullish and Pollyanna type moves of the week all reversed, as we're ending the week.
It's funny, Chris, like I see the ebullience that comes from the lower inflation rate. But inflation itself is still chugging along just quite nicely and doesn't seem to be going to let up anytime soon.
No, it's not. No,
I look at it this way. Like if I had a widget that 2 years ago I sold for $1, and then a year later, that same widget I was selling for $2. That is 100% inflation, correct?
Yep.
If I go another year and my price of my widget rises yet another $1, it's the same price raise. So my inflation is still chugging along. It's now $3, but my rate of inflation is 50%, not 100%, because the the number that they started measuring off of is bigger. And I'm looking at the inflation numbers going, yeah, they're 5%, but 5% of a bigger number, we still have an inflationary problem. And the Fed says so. And the other part of this that I don't understand is for years and years and years, I've been hearing, don't fight the Fed, don't fight the Fed, don't fight the Fed. And now the markets want to fight the Fed.
Oh yeah, and they've been doing it for a while. You know that they started to come around when we had some weakness earlier. They started to come around to the realization that gee, we maybe are going to have a 5% plus federal funds rate sooner rather than later, and the market started to price that back in. Then we had those few bank failures, and it went completely in the opposite direction again. Well, now the regulators are all telling you that that fire has pretty much been put out. Will other banks go bust down the road? Of course. Will commercial real estate be an issue? Of course. Will a lot of other debt be an issue? Of course. But here again, part of the reason why all of these other things will be issues where there's been too much debt, too much stupidity, is because of the Fed's own doing. They know that, and belatedly and maybe hypocritically, they're trying to undo some of that by wanting to, for considerable period of time, have subpar economic growth, higher unemployment, lower stock market, less shadow banking activity, less new securitization activity, so that they don't add to all of those existing problems right now. And again, we criticize the Fed all the time, as we should, and as that central bank as an institution deserves. But in relative terms, and you've heard me say this before, one thing we can accuse Powell and the rest of them for doing now for months is telling us what their game plan is. It's just that the markets don't believe it. So maybe in early next month, when we get another interest rate hike, probably without a guarantee that that's the last one, when they tell us regardless that they're going to continue to roll off the balance sheet, when they tell us regardless, like Waller did today, that they don't like, you got to remember that when the stock market rallies in the face of all of this, it just emboldens the Fed. The Fed says, okay, they don't get it, we'll raise rates more until they do get it, because the markets eventually have to come around to the Fed's desire, which is they want less froth in the markets, less lending without substance, etc. So I think that and again, that doesn't have to be a recipe for a disaster, but it sure as heck is going to knock the pins out from under some of these recent rallies, almost every place, that are all built on a wing and a prayer, and all with this idea that a few of these weaker numbers mean the Fed's about to go into reverse, and they're all going to be proven very wrong, those that are predicting that.
Well, I honestly just can't see where the inflation rate is going to continue to tip down. Here in Prince Edward Island, for those, I'm up in Canada, we've had our gasoline prices have ticked upwards for the last 3 weeks, and quite a substantial amount.
Yep.
I'm reading headlines in Canadian newspapers about workers falling behind in the cost of living, which they are, and the unionized workers are pissed. And we're heading for a lot of labor unrest where they're going to try and drive up their wage rates. So I see a period between energy prices and wage pressures, at least in Canada, and I suspect similarly down in the US as well, as workers try and play catch up, that you're going to see costs push inflation. It's going to continue to drive that inflation rate up. At this stage, with the labor markets being where they are, I think the supply and demand of labor means that labor is actually going to win some of these battles this time around.
Well, labor already is. That has been the case somewhat down in this country too, Mike. And this is one of many things that I pointed out for a while. are the reasons why we are not going back to a sustainable 2% inflation rate again, why a lot of things have changed. We had depressed wages for a very long time. Today, that is both economically and societally a no-no. They're not going to get away with that anymore. When in the case of the US, when Richard Nixon opened the door to China, as the historians like to euphemistically put, what ended up becoming a major sellout of American companies and American workers. He set in motion this whole globalization regimen, which depressed first world wages considerably for 40, 50 years. That's over with. And that's one of the reasons why inflation is going to stay elevated. We've talked before about energy prices. The IEA is out today saying that we're going to have record demand for oil. And by the time 2023 is done, even though supplies still aren't keeping up. So whatever help, we've seen to this point in bringing down month over month inflation rates, that's pretty much done. Food inflation is still bad. I mean, if all you're going to do is go to Walmart and buy a bunch of apparel and stuff that was in surplus in recent months, yeah, inflation's not bad. Some of these outfits are having to give some stuff away that there's a surplus of and little demand for, but that's not across the board. I mean, even the decline after a ridiculous spike in car prices, and then that came back down. That's turned around and going back higher now. So, we are going to live with much higher chronic systemic inflation rate than we've experienced for the last 40 or so years. And it's not, and the Fed knows it. Most people that follow these things understand it. But again, you've got this very binary, simplistic thinking in markets that if the Fed stops raising rates and we get a few weak numbers, then we've all got to rush and get out in front of the coming pivot, which isn't coming, at least not anytime soon. Now, if over the weekend we get 10 more banks go bust and everything is shaky and getting ready to implode, well then all bets are off. But barring something major like that, the Fed has told you what their game plan is, and that's why I think that the course that most markets and most assets have taken recently is the wrong one, and they've all got reality checks coming up in the coming days and weeks.
Well, I got to think at some point they're going to wake from this fever dream that that they're deluding themselves on, that the Fed isn't serious. Even our central bank in Canada, we held our rates for the second meeting. And I'm looking, going like, why are you doing that? The Fed in the US, who, you are our biggest trading partner, is continuing to raise rates. So all you're doing is devaluing the Canadian dollar, reducing its buying power, and creating, yes, you guessed it, more inflation in Canada. And I'm just looking, going like, this makes absolutely no sense. So even the Bank of Canada doesn't seem to believe what the Fed down south is telling them. And I'm seeing similar activities happen with other Feds. It's like, yeah, your Fed says this, but we don't believe them.
Well, we'll see how long that lasts. I mean, the Fed can't run the risk of getting too far out in front of everybody else, because then the US dollar strengthens too much, and that compounds the stress on global markets and on economies both. So I think that, I don't think that the Fed is going to get overly aggressive. I think they're going to continue on this, Chinese water torture kind of course with these smaller rate hikes, maybe one or two more. And then they'll pause and see what happens. They'll keep rates elevated up there. But again, I think that what a lot of people have missed is that, yes, they'll use, when it suits them and when it serves a narrative, they'll use the economic statistics. But then when all is said and done, you get back to the comments like Waller made this morning, and he couldn't have been more blunt. And again, like I said, when we started out, people need to understand that yes, the Fed is all about markets again, but not the way you're used to and not the way you want it to be. The Fed does not want to see these market rallies. They do not want to see animal spirits. Their goal is to wring out as much of the excess that they themselves created since 2008, for as long as they can do it with everything holding together. They're not going to blink when we get 2 quarters in a row of negative GDP, all else being equal, as long as the markets are holding together and functioning. If they still do break something in a much bigger way, which is always possible, then that probably changes. But from time to time in the past, when they've been at a decision-making point like this, they make the distinction that as long as the markets are functioning, don't expect us to run to the rescue anymore. If things seize up and that's a different story. But we're not, even with the bank failures, we weren't really there in a broad sense.
No, it was fairly regional. The two, at least the two in the US that failed. Credit Suisse was a little bit of a bigger problem, but the United States is a different animal than Canada. Like we have, basically the big five within maybe another four smaller national banks that, service the entire country. But we don't have, like, our population is sparse and spread out. So it'd be very hard for regional banks. We do have credit unions, but for regional banks to really function in Canada. So it's not the same. It's not the same thing. And my concern for you guys is that if there's too many of these regional banks start to fold, you're going to start to see regional problems where small local regional companies aren't going to be able to get financing and be able to grow.
No question. And that's one of the things that concerns me greatly. I've used the analogy before about a terrible thing that happened to our country and our society, and I believe our culture in my lifetime, was the planned murder of the family farmer in the US. And I believe it was a very methodical and well-crafted game plan back in the late 70s and into the early 80s to put in motion a number of credit things, monetary decisions, and the like that drove family farmers off the land. They couldn't continue any longer. And so more and more of America's food supply got consolidated into fewer and larger hands. And I've been very plain in fearing that our banking system is going to go that same direction and eventually end up much like Canada's. The people that run this world and the people that run this country very much are oligarchical, if that's the right oligarchical.
Either way, it's a mouthful, isn't it?
Either way, it's a mouthful. And they think that everything needs to be run from the top down. Every decision, every breath that we take during the day needs to be dictated from on high, whether government or some big corporation. And I have no doubt whatsoever that as these things happen, there will be a move towards centralizing more and more that we don't already centralize now. And as you pointed out, in the terms of banks, one of the things that did make small business great in this country, and still does in a couple of the European countries where it's practiced for whatever their other faults are, is you always had that local lender that could look you in the eye, shake your hand. You had the Bailey Brothers Building and Loan that knew their customers, knew their depositors, and you had a good, well-oiled machine that built businesses, provided homes, and supported a local economy. And that's been under attack for years. Didn't start with this banking issue, but this banking issue, I'm sorry to say, will be seized on to bring about a big consolidation in America's banks like you've got up there.
Yeah, as I say, it kind of works up here, but we have a population about the size of Los Angeles. So
Yeah.
It's, it from that standpoint, it's kind of doable, but I can't see where that can possibly work, where you have decisions being made in New York that's going to affect Oklahoma City. I just, it's not good for the economy.
No, no, I agree.
So I'm still of the opinion that something has to break in the job market before we're going to actually see a Fed pivot. And I'm not seeing anything in the job market yet that suggests that we're getting to those kinds of weaknesses where the Fed's going to stop anytime soon. Am I blind to it, or do you see something there that maybe I'm not seeing?
Well, it's a mixed picture right now, but so is the story of the broader economy, Mike. And I think this is another thing where people are trying to figure out what the Fed is going to do, what the markets are going to do today with circumstances that really aren't all what they were in 2016. When the Fed tried to start tightening monetary policy again somewhat, or 2018, I'm sorry, when you had or 2008 or something like that. The economy is all over the place. As I mentioned earlier, with the whole thing with apparel and stuff, you look at retail sales, and if you exclude gasoline, retail sales have been weak for quite a while.
Yeah.
And again, people are not running out and buying everything that they don't need. The only thing that's inducing some people to spend money right now on stuff that they could do without is if they're marked down. And again, clothing is a big one. Some consumer electronics fall into that category, et cetera. But then the flip side of that, you look at the IEA's report from this morning that I alluded to a few minutes ago. People are still traveling. They're still taking delayed trips. They're making decisions that, okay, even if things are getting a little bit tighter, we're still going to spend money on some of these things and not on others. And you can see a lot of these decisions reflected in the job market. It's been well publicized that a lot of the big retailers, even Amazon, the giant of everybody these days, they've announced a number of layoffs. Even some of the delivery companies. Yet at the same time, I still can go out to dinner tonight to one of my favorite restaurants on a Friday night when there's a line at the door, and in some of the places I go to, that half of the tables will still be empty because they don't have the staff.
We live on tourism in the summertime here on Prince Edward Island, and they just had a tourism job fair, and there was more jobs at the fair than there were people looking for the jobs.
Yeah. So that tells you that one of the ways that this may be resolved is that some of the employers are going to have to pay up, and they're going to have to raise their prices a little bit to compensate. And we're going to have that. That's going to be part of the wage push and cost push inflation that is going to stay with us.
Yeah. And I agree with what you're saying about retail sales being down. Our factory orders data came out today for Canada. I'm not sure about the US numbers, but factory orders were down substantially from a month ago, and they've been trending down for quite a while. So, there's excess inventories out there for things. So those things
Right.
are going to go on sale, but you don't eat those things. You don't, you need those things to power
Exactly
things.
right.
So, that's discretionary spending. And I guess if, you lower the price low enough, people will buy, right? So,
Sure. So that's the world that we're in. I mean, there's no question we're going into a period of subpar economic growth. It's going to be with us most likely for a very long time. It's going to be similar in some respects and different in others from what people have been used to in the past. And despite the fact that all of the commentators that I listen to on and off all day long, the old saying is true, they're still fighting the last war. And this is a different set of circumstances that we have today. The outcomes are going to be somewhat different. And we need to understand that.
Well, last question before we wrap up. Is this the start of the stagflation we've been thinking about for a while?
Well, I mean, look, we've been in a growing stagflation for probably the last year and a half or so. If you remember back at the first of the year, I put out a commentary entitled 2023 will bring us more stag in the stagflation picture. So we're seeing that with the economy starting to weaken somewhat more, but the inflation part of it is not going to go away. So are we going to have 8 or 9% inflation for this year? No, but we'll have somewhere between 4 and 6%. Don't forget that 4% inflation was so bad in the 70s in the US that President Nixon imposed wage and price controls. They didn't do much, and they later were abandoned. But look, your point of the widget is well taken. Costs are still going up. If the rate of increase slows down from time to time, that's less bad, but it doesn't mean inflation is gone.
No, we're going to have to see some deflationary periods before inflation's gone.
Yeah, and there's certain things we won't see that in, and we always talk, at least to some extent, about natural resources, and that's again, besides the societal, cultural, and economic changes that are going to continue to keep upward pressure on wages. Likewise, when it comes to a lot of the raw materials that we need in this world, just for everyday life, forget about the build out of these hoped for green economies and all this stuff and all of the infrastructure needs across the board. And all of our listeners know this story. With all of these resources, you had years of underinvestment, years of, to put it kindly, less than helpful economic policies from governments. More often, you had hindrances from government to the point where with everything, we're in short supply. I mean, warehouse stocks of copper worldwide are going to run out the end of this summer, according to the current trajectory. You've got major alarm bells going off with a couple of big consultancies, as well as with a couple of the biggest mining companies in the world, saying, "Hey, folks, we're about to hit a wall. Does anybody care?"
No, they've been whistling past that graveyard for quite a while.
No.
Like commodity prices are still historically low compared to where they should be in this type of environment. And at the end of the day, that's probably the next problem that's going to push inflation is the commodity prices are going to start to move upwards and dramatically as the supply deficit starts to become more and more evident.
Well, and that'll really put the exclamation point on the whole stagflation mix, Mike, because those commodity prices were going to go up, even if the economies in other respects are weakening. I listened to one of the usual permeable suspects at noontime on CNBC today, and this guy's, he's a milder mannered Jim Cramer, but he's not any smarter. And this guy was trying to say that, well, I don't understand why people be interested in commodities, because as the recession comes and yields start to come down, it's going to be an affirmation that the economy is weakening, and these commodity prices will go into reverse because of the weak economy. Well, what planet does this guy live on?
Well, certainly not a supply and demand planet.
No. So anyhow, and so again, this is one of many respects of what we've been saying, that circumstances are different now than they have been in the past at different times like this, and so we need to understand how this stagflation mix is going to evolve, how it's going to be different than past episodes, and do our best to follow the look at all the different scenarios, find the highest probability ones, and that's how we've got to manage our portfolios.
Absolutely. This would be a good jumping off point. There's certainly been interesting times. If people want to follow you and get your Sherpa guidance through this economy, how would they do so?
Just go to nationalinvestor.com. If you're not already on it, sign up for my free mailing list. You get occasional commentaries, occasional special reports, and a variety of different things. Links to podcasts like this that I do with you and myself and others. And also, if you want all of my specific investment information, you can subscribe there and become a member. For the balance of the month, we're keeping our old membership rates, which go up a bit come May 1.
Oh, so there's more inflation coming on May 1.
There's more inflation coming on May 1. I haven't raised the membership prices for several years, but I'm going to modestly.
So I'll remember when the inflation number is higher in May, this is your fault for raising your
fault.
subscription for rates.
That's right.
Thanks very much for joining me, Chris, and I look forward to our next chat.
Yeah, take care, Mike. Thanks.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.